Are investors still keen on big retail deals, despite the economic uncertainties surrounding us? Welcome to the Commercial Real Estate Insights Podcast. I'm your host, Steve Hamoen. Let's get right to it. Retail landlord Kite Realty Group, in partnership with global investor GIC, has acquired a lifestyle center in the Dallas area for a whopping $785 million. This deal is one of the largest in the retail real estate sector this year, coming to fruition despite the looming economic uncertainties. Kite, an Indianapolis-based real estate investment trust, purchased Legacy West, a 344,076 square foot open-air mixed-use center located at 5908 Headquarters Drive in Plano. This property includes not only retail but also multifamily and office spaces, making it a comprehensive asset in their portfolio. Legacy West houses luxury retailers such as Louis Vuitton, Gucci, Chanel, David Yurman, and Tiffany & Co. Kite's partner in this acquisition, GIC, is Singapore's sovereign wealth fund. John Kite, Chairman and Chief Executive Officer of Kite Realty Group, described the deal as a landmark acquisition for the Real Estate Investment Trust. With this acquisition, Kite is expanding its footprint in the Dallas-Fort Worth market and plans to partner with GIC on future transactions. Kite is not alone in reporting strong leasing activity. Other retail landlords, like New York-based Urban Edge Properties and Brixmor Property Group, have also discussed robust leasing despite the threat of tariffs over the industry. However, Urban Edge CEO Jeff Olson noted a shift in the investment market, indicating that while retailer demand remains unchanged, the investment sales market is showing early signs of slowing down. This is partly due to limited commercial mortgage-backed securities issuance since April, with real estate investment trusts and foreign investors pausing their activities. In contrast, Kite Realty Group, along with its foreign joint venture partner, tells a different story. John Kite mentioned that there are still very active acquisition buyers out there, and despite geopolitical uncertainties, operationally, the situation seems better. Nationally, the retail investment market gained momentum throughout 2024, with annual sales volume climbing by 5% year over year to $57 billion, as reported by CoStar. Kite Realty Group closed several sales and acquisitions, including the joint venture with GIC to co-invest in high-quality, open-air retail and mixed-use assets. In the Legacy West deal, Kite's share of the purchase price was $408 million, and the Real Estate Investment Trust will act as the operating member of the joint venture, holding a 52% majority interest in the property. As part of the acquisition, the joint venture assumed a $304 million mortgage at a 3.8% coupon. The Legacy West purchase marks just the beginning of plans for the joint venture, which include additional growth opportunities. Kite and GIC have a non-binding letter of intent to seed a second joint venture with some of the Real Estate Investment Trust's larger format community and power centers. These seed assets include locations in Florida and Texas. The center's average retail sales exceed $1,000 per square foot, indicating dominant retail performance and the potential for meaningful upside from below-market rent. The acquisition also establishes relationships with global luxury tenants like LVMH and Kering, leveraging Kite's experience in operating lifestyle and mixed-use properties. It accelerates leasing synergies within Kite's lifestyle portfolio, including the nearby shops at Legacy East. As we navigate through 2025, the office real estate market presents both challenges and opportunities. According to an article by Mortgage Professional America magazine, the office space is still grappling with the aftermath of the pandemic, with a national office vacancy rate climbing to 19.9% in March. This marks a significant year-over-year increase of 170 basis points. Yet amidst these challenges, there's potential for a turnaround, especially in Class A and B office properties. Alex Horn, the managing partner of Bridge Invest, highlights the difficult landscape for Class C and some Class B offices, attributing it to changes in how offices are utilized across the country. Horn suggests that supply destruction is necessary for these classes due to decreased demand. However, he sees a promising future for Class A and some Class B spaces, particularly in good markets, where rent is a marginal part of the budget for tenants. Horn emphasizes the importance of amenity-rich buildings in attracting talent, especially for companies that require in-person collaboration. These companies are willing to pay premium prices for quality office spaces, driving a rebound in Class A office markets. A recent example is Deloitte's commitment to high-end office space in Manhattan, signaling confidence in the office sector. Despite challenges such as fluctuating interest rates influenced by tariffs, Horn believes that companies ready to move forward can find opportunities with lenders like Bridge Invest, who are prepared to support refinancing or new acquisitions in the office market. This approach could help bridge the gap for businesses looking to capitalize on the evolving office landscape. Looking at the multifamily sector, Horn expresses optimism as well. A report from the Mortgage Bankers Association noted a 5.4% increase in multifamily debt at the end of 2024, reaching $2.16 trillion. This growth trend has outpaced the broader commercial real estate sector for 10 consecutive quarters, suggesting a robust market despite rising replacement costs due to tariffs and labor expenses. Horn mentions that the increased cost of replacement makes new developments more challenging. However, if projects can justify their costs and potential for rent growth, they present attractive opportunities. This sentiment aligns with the broader confidence in the multifamily market, highlighting its resilience and potential for continued appreciation. Commercial space in Northwest Arkansas reached impressive occupancy levels in the latter half of 2024, even as over 2 million square feet were introduced in the previous 2 years. According to the latest Skyline report commissioned by Arvest Bank, the vacancy rate for leasable commercial space dropped to 5.8%, marking the lowest point since the second half of 2022, which saw a rate of 5.6%. The report, produced by the Center for Business and Economic Research at the Sam M. Walton School of Business at the University of Arkansas, highlights a decrease in the overall vacancy rate from 6.5% in the first half of 2024. Since 2022, a total of 2,181,915 square feet of new commercial space has been developed in the region. Mervyn Jebaraj, director of the Center for Business, noted that vacancy rates declined across the major sectors of commercial space, which include office, retail, and warehouse spaces, when compared to the first half of 2024. He described the commercial real estate market in Northwest Arkansas as balanced and healthy, despite the addition of significant new space. Jebaraj also mentioned that the center will monitor building permits in the first half of 2025. If the decline from the second half of last year continues and demand remains strong, vacancy rates could potentially keep decreasing. The Skyline report further found that the hotel market in Northwest Arkansas is experiencing robust growth. Between 2009 and 2024, the number of hotel rooms increased by less than 10%, adding 600 rooms, while the resident population grew by almost 40%. However, at the end of 2024, there are 1,190 hotel rooms under construction across 10 new properties, which would nearly double the new rooms available in the last 15 years. Isaac McKinney, Executive Vice President and Loan Manager at Arvest Bank's Siloam Springs region, expressed that the market in Northwest Arkansas continues to defy national trends, offering a favorable environment for business and living. The headquarters building for Chewy, located on Congress Street in the Fort Point area of Boston, has recently been acquired for $48 million. This building, serving as the workplace for the pet e-commerce company, is part of a vibrant commercial district known for its blend of office and restaurant spaces. This transaction reflects ongoing interest in the Boston commercial real estate market, where properties in prime locations like Fort Point continue to attract substantial investments. The sale of the Chewy headquarters underscores the appeal of mixed-use buildings that offer both office and dining options, catering to the dynamic needs of urban professionals. While the Boston market sees such significant transactions, it's interesting to compare it to the commercial real estate landscape in Kitchener-Waterloo, Ontario. In this Canadian region, similar mixed-use developments are gaining traction, driven by a growing tech sector and increasing demand for integrated work-life spaces. These areas are seeing a rise in tenant leasing activities, particularly in the multifamily and office sectors. In the United States, cities across the border are experiencing similar trends, with multifamily properties and tenant leasing remaining strong in tech hubs and urban centers. This cross-border relevance highlights the interconnected nature of commercial real estate markets, where shifts in one region can reflect broader patterns in another. The Commercial Real Estate Insights podcast continues with a focus on an innovative approach to addressing the housing shortage using commercial properties. In Las Vegas, a former Kmart store on Spring Mountain Road has caught the attention of Nevada lawmakers as a potential site for housing solutions. This development comes as part of Assembly Bill 241, introduced by Democratic Assembly Majority Leader Sandra Jauregui, which aims to ease zoning laws and repurpose commercial spaces for multifamily housing. According to Jauregui, rezoning commercial properties for multifamily housing offers a practical and immediate solution to increase housing supply and tackle affordability issues. This bill, which passed the Assembly with a 28-14 vote on April 17th, seeks to encourage infill development and promote mixed-use projects that could lead to more workforce housing options. These developments are envisioned as affordable units for workers, conveniently located near transportation and shopping facilities. The bill was presented in the Senate Committee on Commerce and Labor, where Jauregui emphasized the importance of adapting commercially zoned properties for mixed-use and multifamily purposes. She noted the necessity of balancing developers' goals with community needs, stating, "They're not going to put in luxury condos at the Kmart at Spring Mountain and Rainbow," highlighting the focus on practical and market-driven housing solutions. Republican State Senator Skip Daly pointed out that developers tend to focus on projects that represent the highest best use, which can sometimes conflict with affordable housing goals. However, Jauregui argued that with proper control, it is possible to achieve the desired outcomes for housing supply expansion. The bill requires counties and cities to accommodate mixed-use development on commercially zoned properties, while allowing local governments to retain decision-making authority over specific projects. This approach in Las Vegas reflects a broader trend seen in various regions, including Ontario, Canada, where similar strategies are being considered to address housing shortages. In cities like Kitchener-Waterloo, London, and Cambridge, the need for increased housing supply is prompting discussions around the potential repurposing of commercial spaces for residential use. This cross-border relevance underscores the interconnected nature of real estate markets and the shared challenges in balancing commercial development with housing needs. Thank you for listening to the Commercial Real Estate Insights podcast. I'm your host, Steve Hamoen. See you on the next one.